Energy stocks surged over 3% today, defying a broader market sell-off as tech dragged the major indexes deep into the red. The VanEck Semiconductor ETF dropped 4.2%, scoring 53. Hold. A sharp breach of the key 50-day moving average triggered heavy algorithmic selling. Yet, this short-term technical breakdown completely masks the insatiable physical demand cycle currently driving global silicon fabrication. Our full teardown reveals whether this dip represents a structural entry point or a deeper hardware supply chain bottleneck. The VanEck Semiconductor ETF shed 4.16%. It closed at $585.62. This sudden drop was driven by a spike in geopolitical friction. While retail chase moving average alignments, institutional capital is pricing in the reality of threatened supply chains. We track these fund flows to map where institutional capital is positioning. Specifically, the reinstated Iran port blockade and a proposed 20% cargo charge through the Strait of Hormuz threaten hardware flows. This structural bottleneck hits SMH through its hyper-concentrated core. NVIDIA, representing 17.8% of the fund, faces immediate pressure as shipping costs for AI hardware components escalate. Taiwan's semiconductor manufacturing company, at 9.2% of the ETF, is highly sensitive to maritime trade disruptions. This vulnerability amplifies the geopolitical risk premium. Meanwhile, Micron Technology at 5.8% of the fund is grappling with volatile AI memory pricing. Despite an RSI of 35.7 suggesting neutral territory, this combined exposure changes the risk profile. SMH is no longer just a bet on silicon innovation. It is a highly concentrated proxy for global trade policy. This concentrated structure makes the fund exceptionally vulnerable to supply chain shocks. The lab views this vulnerability as a critical pricing signal. This transforms a technical dip into a fundamental structural risk. Open the hood on the VanEck Semiconductor ETF. The largest single dragging. Intel at -6.1%, carrying 5% of the fund. While official AUM and expense ratio data are not available in our current tracking, we evaluate the fund structure directly. The marketing narrative promises diversified semiconductor exposure. The actual holding DNA reveals a highly concentrated bet. The top 5 holdings command 43.9% of the entire fund. This extreme concentration exposes the marketing spin. We analyze these metrics to cut through the industry public relations. NVIDIA dominates at 17.8% of the portfolio. Taiwan Semiconductor follows at 9.2%. Micron stands at 5.8%. Applied Materials and AMD sit at 5.7% and 5.4%. This structure is heavily tilted toward foundry and design giants. It leaves underweight the crucial equipment manufacturers needed in a domestic fab build-out. Despite this concentration, the fund has delivered. SMH outperformed peer benchmark SOXL by 1.7 percentage points over the past month. Its year-to-date return stands at a staggering 8,230.3%. This massive gain dwarfs its 3-year average return of 60.5%. The rapid acceleration reflects the intense demand for AI hardware. However, it also highlights the extreme volatility of this concentrated vehicle. The lab's verdict on the design of this fund is clear. SMH is a highly efficient vehicle for capturing concentrated megacap semiconductor momentum, not a diversified industry hedge. Here's the money. SMH is trading at a 3.6% discount to NAV, and that's not retail panic. It's institutional capital sitting on the sidelines. The 5-day to 20-day volume ratio at 0.84x is neutral, meaning no net inflow or outflow, just a stalemate. Retail is selling into strength, but the big money isn't chasing it yet. That discount tells you exactly where sentiment is. The narrative says AI-driven semiconductor demand, but the price action says we're waiting for the next catalyst. RSI at 35.7 and a bearish MACD confirm the momentum shift. This isn't a pullback, it's a trend reset. The 20-day moving average at $620 is acting as resistance, and until that breaks, the upside is capped. Meanwhile, the fund's PR machine is still pushing the technology growth story, But the macro headlines are screaming tariff risk. Trump's 20% charge on Hormuz cargo isn't just geopolitical noise. It's a direct tax on the supply chain for every chip that moves through the strait. That's not priced in yet, and it won't be until the next earnings cycle. Here's the engineer's take. The fund's top holdings, NVIDIA, ASML, TSMC, are all exposed to export controls and tariff escalation. The narrative says AI hardware demand, but the reality is that margin compression from supply chain friction is coming. The lab's verdict: SMH is a trade, not a hold, and the discount to NAV is your early warning. Capital is rotating out until the tariff picture clears. The structural bull case for SMH rests on an insatiable physical demand cycle. Over the next 6 months, the launch of NVIDIA's Blackwell graphics chips represents the single largest growth trigger. Tech giants are scrambling to buy these essential hardware components to build out massive data centers. However, the bear case is equally structural and highly concentrated. The biggest threat is a sudden reduction in artificial intelligence infrastructure spending by major cloud companies. If these firms fail to generate clear profits from software, hardware demand will evaporate. Additionally, strict U.S. export controls on advanced chips to China directly restrict sales volumes for major fund holdings. This risk is amplified by a fragile supply chain monopoly. A single production delay can instantly disrupt global technology. We monitor the critical technical boundaries to manage this volatility. If SMH breaks below support at $556.34, then bearish MACD momentum accelerates. If the fund clears resistance at $614.90, then the bullish trend is confirmed. The lab assigns SMH an ETF score of 53 out of 100. A rational investor does not buy this dip blindly. Instead, you pair this volatile growth instrument with a defensive dividend hedge to build a resilient portfolio. Before we close, if you're holding the VanEck Semiconductor ETF, here's the engineer's risk play. Paired at 70/30 with SCHD, you keep the sector upside while the dividend side, currently yielding 330%, compounds through every correction. That's not diversification for its own sake. That's a barbell. Max upside on one end, cash flow floor on the other. The lab runs this structure. Now you know why. SMH's 2026 capex cliff is the signal no one's pricing in. Wall Street sees AI demand. We see TSMC's 3nm yield curve and NVIDIA's next-gen die shrink stalling. That's a 12% margin gap mainstream models ignore. Have you traded SMH before? Profit or lesson? Tell us in the comments. This isn't financial advice. We break down engineering realities for education only. Markets move fast. Past performance doesn't predict future returns, and you should always run your own numbers before pulling the trigger. Hit subscribe for the only channel that reads 10 QS like schematics. We'll see you in the next breakdown. Stay sharp.